Hello and welcome. This is Countdown on BloombergQuint, India's first live streaming business news service. I am Amar. Let's start by taking a look at the headlines. Markets trade with a negative bias. The Nifty trades below 12,200. Auto and FMCG stocks are the principal laggards. Disruption in oil supplies from Iraq can disrupt the global oil market, according to Fatih Birol of the International Energy Agency. That's BloombergQuint exclusive from Davos. Dish TV is trading with gains after Bloomberg reports that their talks for a merger with Airtel Digital are set to have stalled over the structure of the deal. And Zee Entertainment is among the top Nifty gainers ahead of the third quarter earnings. But that said, Devina, good afternoon. We're looking at some amount of weakness today.
Yeah, more carrying forward from yesterday's session where we actually managed to just about perch ourselves on the 20-day moving average. But today seems like a breach of that. And now the 50-day moving average becomes even more crucial, which falls somewhere closer to 12,101. We're just about around 83 points away from there. But let's see how the rest of the day shapes up as well. So now down about 1/3%. This is not the lowest point of the day, but still not being able to gather much momentum towards the fag end of the trading session. The Nifty Bank too contributing to the downside. A pretty similar graph as to what the Nifty has done the whole day. It's down about 0.4%. Coming to the heat map, and we'll talk about the contributors to these losses. Far and few in terms of the kind of gains that we're seeing, but Bharti Infratel for one is actually doing really well. Remember the knock it took just 2 days ago. The stock's up about 7.5%. Zee ahead of numbers is actually doing well for itself. Then you've got HDFC Limited, IndusInd Bank, marginal recovery that's coming back into the counter. SBI is doing okay, and Bharti too is up 1/3%. But the quantum of gains for the gainers is very limited. Amongst the losers, the big drop for Asian Paints is down about 2.5%. Power Grid, M&M, IOC too continues its losses from the exit, from the changes with regards to the exclusion from the Nifty CPSE index. ITC is down 1.5%. You've got HDFC Bank, a larger weighted stock, they're down 1%. And quickly look at Reliance Industries also in today's session. That's just marginally higher by 1/4%. But the theme seems to be more red across the board. There is pain. The breadth of the market looks weak, and that will come up on your screens as well. Broader market space giving back in today's session. Mid caps and the small caps also looking weak. Flattish for the index itself, but you have a slew of losers, but I'll talk about them after the gainers. LIC Housing Finance is having a good day along with PNB Housing Finance as well. Both the stocks are up closer to 4%. Jindal Steel and Power 3.5% higher. RBL Bank, remember, lost out in yesterday's session, so a little bit of a bounce back coming back today. Fortis and Modern Beverages along with Mahanagar Gas, which is up about 1.5%. City Gas distributors are having a field time over this last 1 week to 10 days. What's losing? Edelweiss is down another 2%. HEG, Castrol, Godrej Properties. Godrej Properties features amongst the list after some time now because the stock has been stagnated in that range of about 970 to 980. Today has seen a collapse on the downside. Coming to the small cap index and what's moving there as well, a marginal outperformance that we have seen compared to what the others are doing. This one is actually in the green. Canfin Homes, management commentary extremely positive. I think 20% growth is what they've spoken about, and that is keeping the street really excited. Dish TV as well as up about 5%. Spandana Spurti, KEI Industries, remember the cable segment had a revenue growth of 25%, and that's good going for the counter. It's up about 3% on the back of numbers. Rallis continues on good numbers, and then you've got the rest which have not done well. Suntech, Chennai Petro, Kochi Chipya, these are all looking weak. But also important to see what's been happening in the futures and options space. Agam's going to wrap that out for us. Agam.
Right, so we are looking at weakness. It's evident in the screen. We're looking at the Sensex and the Nifty declining, as is the case for the Bank Nifty. So for the Nifty, there's a 4% increase in open interest towards fresh shorts. For the Bank Nifty, there is also some selling coming through, and that should come up on your screen soon. The Bank Nifty is what I'm talking about. Yes, about 11% decline there as well, about 0.5% cut on the underlying. The India Volatility Index, as expected, has also spiked further and advancing towards the mark of 16. And we're watching out for levels which would, and we're clearly seeing a lot more writing around the 12,200 call, considering we have seen the Nifty give away. Now the 12,200 mark, as you can see, is the one with the max OI along with 12,300. So that's been a result of the kind of selling that we have seen, the writing of these two call options. And well, today is a continuation of the trend, considering the 12,200 call is the one with the most amount of accumulation today as well. And again, on account of the fact that the Nifty is currently trending below the mark of 12,200. Let's talk about stocks then, and we do have Bharti Infratel, which is right at the top of the Nifty gainers. It's up nearly 8%, 6% added in open interest. There's longs coming there. Moving on to a handful of other stocks, we also have LIC Housing Finance from the mid-cap space, which is doing reasonably well on a day when there has been weakness across the board. Well, of course, these are the kind of gainers, and along with that, we have RBL Bank as well, which is advancing by around 3.5%, 10% added in open interest towards longs. And well, in terms of some stocks which are looking at some amount of weakness, we have PFC, which is declining by nearly 5%. Open interest increase of 51% towards shorts, selling coming along there as well. But all in all, needless to say, we may have seen a little bit of recovery earlier on the session, but it's not stayed, and the selling pressure has resumed at this point in time, Devina.
All right, let's talk more markets then. And before I get on our guests on what I want to talk about, two stocks that reported numbers. One is ICICI Pru that reported its numbers. I think the stock made an immediate dash for the top. Now it's cooled off from the highs, but at 490, you had an inline set of numbers. AP growth by 1.2%. The gross premium grew by about 9.2%. So the market got excited a bit, and now it's come off. And the other one is Granules India. We've got a decent set of numbers as well as the buyback there, which initially kept the stock active. The numbers came out, I think, 20 minutes ago, and then from there it's come off to about, still in the green though, by about 0.5%. Let's welcome our market voice in, Mr. Srinivas Ravuri. He's the CIO at PGIM India Mutual Fund, and he's joining us right now on the show. Srinivas, thanks very much for taking out the time. What have you made out of this, sudden change in the market mood? I mean, it did look toppish when we made those record highs for no fundamentals to back it. But did you feel that this is just an opportunity to enter right now?
Well, I think people have been talking about this contrast. One hand we are seeing GDP numbers going down, and markets are going up, and there is a growing number of people who are in the disbelief camp. What is wrong with the market? I think that's where we've seen even a minor disappointment on numbers, markets correcting significantly, because overall there is a concern that why markets are moving up when you don't see anything in terms of economic activity revival. If you see the numbers that have come up also, clearly we are seeing slowdown in the consumption continuing.
Private sector banks are also showing the loan book growth has been a bit disappointing.
Correct. We're talking about banks which used to do 20% have now down to 14%. So there is a clear concern. I think more and more people are clearly saying that revival is going to take time, and that is a worry for everyone.
All right, so how are you placing your bets? And I just want to talk about the funds which may be focused in your large caps, perhaps your Nifty and Sensex constituents. What's going on there? Because there is polarization. We've spoken enough about that. But really, how are you going about allocating funds here?
So I think it's a big concern, polarization, a few stocks doing well. But I think as an active fund manager, our job is to take active bets, and I think that's what we're doing. If you see our portfolios, so I've increased exposure to utilities, pharma, chemicals, and kind of reduced weight to financials.
Okay.
That's interesting because, so far up until now, the theme has been financials and service driven. Asset heavy industries like energy, metals, autos have taken a bit of a backseat, at least in 2019. Do you see that trend continuing for 2022? I
think it will actually change. I think, it is very natural. I think 19 is one of the worst years we have seen in terms of economic activity. The kind of, we all know that, core sectors were not doing well in the first half also, but in the second half of 2019, we've seen a clear slowdown in the consumption space as well. So when you have, and on top of that, we had, quite a few new problems that have emerged in terms of, crisis that we saw in NBFCs. I think in such situation, people will tend to flight to safety tend to happen. People wanted to be in companies where they have comfort on quality, earnings, etc. I think the moment you see economic recovery, we will see this getting more broad-based. Finally, we as a fund managers are slave to earnings.
Right.
I think today, these top 4 or 5 companies, very high quality, and there is a reasonable earnings growth. And the other side, we've seen disappointment on earnings, and we've seen other challenges as well. But the moment we see things changing and earnings growth, coming back in the other category, I think we all will shift. I think we've started seeing that happening already a bit in the last 10-15 days. I think that trend will get accelerated the moment I have some clarity, comfort that we will see a recovery in the economy.
All right, Srinivas, my question then is, if you consider cash levels, do you have relatively higher cash levels at this point in time as compared to, say, perhaps 3 months or 6 months back? And secondly, again, it's about valuations. What are you factoring in when it comes to the next 6 months? And based on that, how are you valuing the market right now?
Sure. So first on the cash parts, generally we don't take cash calls. When someone is investing money into our equity funds, we believe he has taken that asset allocation call. So money is given to me means I need to deploy it.
Okay.
So we tend to keep about 2 to 5% cash. I think that remains. There is no change in that. In terms of valuations, I think, let's say there are 3 buckets. One is very high quality but very, very high expensive.
Yeah.
Second is high quality. But there are concerns on earnings, and that's the reason why I think the valuations are somewhat expensive. Auto I would put in that category.
Yeah.
Third bucket is, there is a deep value today. I think I am more interested, excited in that value space.
Okay.
I think it'll take time, but I think that is where I think the risk reward is clearly in favor of investors.
Right.
Okay. Let's talk about what could disrupt this momentum. We're already seeing signs right now that there's some amount of exhaustion or fatigue coming in for the index, at least the larger names not delivering the kind of excitement that you've entered this earnings season with.
Yeah.
So globally, domestically, domestic funds yesterday also sold out. Do you feel that there could be more pressure building up with regards to the fund activity?
Yeah. So I think 2 things. First is earnings. We are all expecting third quarter numbers, December quarter numbers to be pretty good, and fourth quarter to be good. For 2 reasons. One, I think you have a base effect, and second is the benefit of tax rates. So I think so that earning growth should continue. And second, I think which is all very, very important is I think I'm in the markets for now almost 25 years. I think for the first time in many years, I think there is a lot of expectations on what will happen in this budget. I think expectations are fairly high, and one has to see what will actually happen. So I think on these 2 counts, if there is a disappointment, and then one need to be worried.
Yeah. All right. Well, I do see a significant amount of allocation towards financials in some of your funds. My question then is, well, recently, we've had Kotak Mahindra Bank, say that when it comes to credit, there's been a little bit of a slowdown there, even for good corporates, where they have limits, they're not fulfilling their limits. There is a slowdown in advances as well as all the other factors. Based on that, how do you see these concerns, and how would you push forward when it comes to allocations towards some of these banks, not necessarily only towards Kotak Mahindra Bank, but some of the leading banks here?
And the fact that Axis and ICICI are yet to report on what could come out from there, because the telltale signs are where the retail is starting to look like a problem now.
Yeah. So I think the first part is financial weightages. If you see any mutual fund, diversified equity fund, our holdings tend to be, I think number 1 holding would be financial services, because the benchmark weights are anywhere from 30 to 37% depending on which index you are. So, we all have to respect benchmarks. So if I'm very bearish, if the particular stock is 9%, maybe I'll go to 3-4%, you don't make it 0. And that's the reason why you see financials being relatively, overweight, not overweight, but in terms of number 1 holding for mutual funds across diversified fund. Coming to the second point, I think today this is really a big challenge. Corporates that need money are not getting money from banks. There is an extreme aversion from banks to lend to, let's say, infra sector.
Yeah.
This needs to change. So I think that's one thing that people are looking forward to, what can happen to see that happens. But having said that, I think on the personal retail lending space, I think there is still a long way to go. I think, I was going through the SBI Caps DRHP. You see very interesting data on overall, markets. So there are only 45 million credit cards in India today versus 800 million debit cards. If you see unique cards, it will only be about 35. So versus a 130 crore population, we are talking about a 35 million credit cards. So that number is very, very small.
Right.
I think this number can be easily 4-5x in the next 5-7 years. So I think that's a huge opportunity. So I think overall financials, yes, I think there are pockets where we see stress, but I think there are some pockets where there is still a reasonable opportunity.
Okay, just a final question before we let you go. Well, it's on the chemical sector, and again, I'm looking at your mid-cap space, mid-cap fund specifically.
Yeah.
Can you tell us a little more about how things are panning out between China and well, India, and why your preference lies here?
Sure, I think chemical is one sector that we are extremely bullish, positive. Chemicals overall and specialty chemicals in particular is what I like. I think two things are happening. One, as China is becoming much more stringent on environmental norms, pollution norms, we are actually seeing companies closing down facilities there, and that is becoming an opportunity for Indian companies. And second, so an MNC which is dealing with Chinese companies and sourcing from Chinese companies, and now they've been compelled to look at Indian companies, and they've seen Indian companies and they've visited, done the due diligence. Actually, they are pleasantly surprised by the kind of product that they're getting, the price they're getting.
Yes.
So more and more people are actually saying that I want to have India as a sourcing base, for sure.
Sure.
And we've seen in some cases these clients actually funding the capex needs of the Indian company. I think this is a good structural long-term story for India.
Okay.
And that's the reason why we are so positive on chemicals.
Okay.
All right, we'll leave it at that, Srinivas. Thank you very much for joining us. Really.
Thanks to you all.
Thank you. All right, the auto sector is back in focus. There seems to be no respite for the automakers as the slowdown continues to persist. Recent data from FADA indicates a 15% decline in total vehicle registrations for the month of December. Let's discuss the factors behind this and whether there are any green shoots visible on ground with Vinkesh Gulati, the Vice President of FADA. He joins us on the phone line right now. Vinkesh, thanks very much for taking out the time. So clearly no visible signs as of now, at least. We've still got some pressures building up. With regards to inventory, are there any material changes aside from the fact that registrations have not picked up?
Yeah. So overall situation is not that great. It's still grim, and that is what we have said, that we are very cautious for the near and mid-term future. And additional to what we have seen in December, this quarter is also a problem because the transition from BS4 to BS6 will happen this quarter. And obviously the dealers and the OEMs are cautious on carrying huge stocks. So we are expecting that maybe January be a bit normal, but till March the figures would not be that great.
What is the kind of deficit that you're looking at in terms of, whether or not the registrations can further dip in the month of January?
So January would be a bit fine. I'm not saying that we'll see similar degrowth what we have seen in December, because actually there are a lot of customers. The inquiries are there, and they were expecting huge discounts to schemes to come in December, and they were expecting that because of the BS6 transition, a fire sale or a distress sale will happen, which now slowly and steadily the message has gone around that it won't be the same case because inventory is in control as of today. And BS6 products are already, some companies have launched it, some has given up the price and given a date when the product would be there. So the message from the dealer fraternity to the customers is that they shouldn't expect bigger discounts than this. So we are expecting January the customers who are waiting to buy on expectation of huge discounts will convert, and the deals will be closed. So I'm not seeing the similar degrowth as in December and January. But obviously because of this transition, we are a bit cautious about how the numbers will come in this quarter.
Vinkesh, just want a little more clarity when it comes to inventory days. From what we understand, that the inventory days have also fallen, and this is surprisingly in the backdrop when there has been degrowth. Can you give us any more clarity on this aspect?
See, See, actually, we had seen a good October-November sales, and because of that, we had really controlled the inventory at that time, and slowly and steadily, this figure comparison of retail sales actually last year, December, when we weren't controlling the inventory, we were gung-ho that was the starting of the period when we started seeing the degrowth happening. And at that time, the transition of BS4, BS6, and we being cautious and inventory wasn't there. So retail comparison is obviously what we have seen year on year, but inventory comparison comes as month on month. So that is why this difference you are able to see.
All right, Vinkesh, in terms of categories, perhaps if you could give us a better idea in terms of passenger vehicles, how things are shaping up right now, and whether or not you are seeing any change in terms of, well, categories specifically.
So I feel passenger vehicle should be fine in December, so in January, sorry, and we are not expecting the 9-10% degrowth in January. January would be a bit better. It will be, there are chances of degrowth, but it will be very, very nominal. But if we talk specifically on the two-wheeler, we are not seeing green shoots coming in. The degrowth would be around 9-10. That is what our expectations are, and that's what our dealer inputs are coming to us. So similarly, CV also is in a bad shape, so we don't expect a lot there also.
Okay, got that. Yeah. Venkesh, we'll leave it at that. Thank you very much for joining us.
Thanks for
and highlighting for us what's happening on ground. So clearly, the pressure continues to persist, and we're seeing that in the kind of dip in registration, new car registration numbers that have just recently come out. Moving away from that, Tim Moe of Goldman Sachs is expecting investors in Asia-Pacific markets to book profits post the recent outperformance ahead of the lunar holiday. Speaking to Bloomberg TV's Stephen Engel, Moe believes that there is a conflict between fundamentals and valuations that prevails in the Asian markets. Listen in.
Certainly is a setup here where people were prone to taking some profit and locking down positions ahead of the Lunar New Year holiday. And that comes in the context of what we think is the biggest situation in markets, which is this opposition between ex-medical concerns, as you just mentioned, a gradually but notably improving fundamental environment versus how much has been priced by last year's very good performance.
Right.
So the key setup here in dynamic is that conflict between fundamentals and valuation. And our sense here is that with the markets having had a very good run, particularly in the fourth quarter of last year, and then that extending into January, that with the holiday coming up and this new information that's come in, that's an opportunity to kind of square positions and lock things down ahead of the holiday.
Well, you had already said in some of your notes that you were expecting a bit of a pullback for Asian equities this year after this, this rally that we've seen globally has been kind of long in the tooth. So is this perhaps an earlier trigger than you expected?
I mean, it could be. I mean, there's always some sort of surprise. I mean, Donald Rumsfeld is famous for the known knowns, the known unknowns, the known unknowns. Yeah. And this latter concern about the coronavirus certainly falls into either one of those latter categories. It's certainly not the known knowns or the risk of, say, U.S. political election, which we could discuss perhaps later on. I have no differentiated view or knowledge in terms of whether this is going to become something, more significant like SARS or something which could diminish.
It's too early to extrapolate onto
for sure.
comparison.
And
it's a similar virus. That's what we know. We're
correct.
not talking contagion or anything like that.
And certainly there is a scenario where, especially in advance of the Lunar New Year holiday, when many people travel, and just given the greater connectivity we've got globally, the concern about some sort of contagion is not unfounded.
So maybe pull some money off the table, see how this transpires over the holiday, if it spreads, and then back into the market?
Perhaps. I mean, I think the larger point you'd like to make is that we think there's been a good reason, which we can get into later perhaps, for the market starting the new year on a good note, which so far has happened until this most recent dip that we've seen. That could extend further on into the first quarter After that, our sense has been that the market would be vulnerable to some sort of a correction. Now, frankly speaking, that's not a terribly bold prediction to make, because every year's got its dips. But I think the point we'd make is that right now the tension between fundamentals and how much is priced is particularly acute. If I could just extend on that for one moment to put some numbers out, the MSCI Asia Pacific ex-Japan Index, which is the broader benchmark that we follow, is currently trading at 14.4 times 12-month forward consensus earnings. Now, the peak in the 10 years following the global financial crisis has been 14.1, 14.2.
Yeah.
When markets peaked in January of 2018, that was at about 14.2 times earnings. So we're right at the very, very top of the range, about 2 standard deviations above the 10-year mean, which suggests that the market is pricing a pretty robust recovery in earnings and is probably implicitly expecting even a bit more in terms of positive surprises. So that just renders it a little bit vulnerable to any marginal news that comes out that's a bit more concerning, and this coronavirus stuff could be just a catalyst that kind of catalyzes that situation.
All right, there, Goldman Sachs' Tim Moe there highlighting the vulnerability of the possibility of a pullout ahead of the lunar holiday. Can't really tell how big the coronavirus contagion can be and the impact of that on the economy as a whole, but that's too early to talk about right now. But nonetheless, valuations itself, he said, are pretty stretched at this point, so profit-taking could be due. Moving on, earnings then are in focus here as well. Zee Entertainment is the only Nifty company reporting its earnings today. While subscription revenues are likely to remain robust, advertising revenues may decline owing to the channel's conversion to pay from free to air. Forum Bhatt, she's here to take us through what the street is expecting.
Well, a weak set of numbers are expected for Zee this time around. Revenue is seen down by 2% to 2,116 crore. EBITDA seen down 32% at rupees 597 crore rupees, and net profit is seen down by 24%. Margins are seen at 28% for Q3 versus 39% a year ago. So one of the reasons for decline in top line is basically decline in ad revenue for the company. As we all know, the slowdown in economy has led the advertisers to spend less, which has in turn impacted the ad revenue for Zee. Besides that, high base effect is something which will prove to be a negative for the company this time. Other than that, conversion from free to air to pay channels is something which continues to have a negative impact on the revenues for the company. While ad revenue is expected to decline this quarter, subscription revenue will see a healthy growth for the company. One of the reasons for that is on account of tailwinds from the new tariff order. Other than that, viewership gains in some of the portfolio channels is something which will lead to growth for the subscription income. EBITDA is expected to contract on account of two factors, one of them being decline in ad revenue and the other being higher programming and new content costs which the company will incur this quarter. Now looking at some of the other factors, new amendments proposed by TRAI are not likely to have any impact on the business this time around for the company, as it will come into effect from March 2020. Slowdown in subscription revenue will be seen from Q4 under the new tariff order regime, as the prices will have to go down. Other than that, the company has also launched 4 new general entertainment channels, which should provide a foothold in the respective regions from the next quarter for the company.
Well, moving on to a Bloomberg exclusive. Dish TV's merger talks are said to have stalled over differences over the deal structure. We have PR Sanjay of Bloomberg News, who broke the story, is joining us with us right now on the details. Sanjay, what are the latest?
So this Airtel deal has been there in the market for some time. So there were some differences which has arisen in the kind of in the deal structure, where Dish TV wanted cash offer, but Bharti was not in a position to offer cash at this point of time. You very well know Bharti and Vodafone and other telecom operators are fighting out with Supreme Court for their past dues issues. So Bharti was not in agreement with the terms which is put forth by Dish TV. That's what we understand. While the C Group company, which is Dish, was insisting on cash offer, Bharti is not willing to pick that bait, and they are insisting shares instead of cash. So this deal is now put on back burner. So we have asked various sources. They clearly said it is not called off at this point of time, but they have put on the cold storage for now, since the telecom company is battling with various other issues, while Dish TV wanted to pursue actively, but at this point of time, the deal is on back burner.
Was this considered an overhang for Dish TV? Because the stock is actually in the green today. So I'm just trying to understand from you.
So the market has actually, absorbed the stuff what is there in the market, because one would also know it's that the issue, telecom issues is very, very live and burning at this point of time. Even today, Supreme Court has said, so there's some good news where they're willing to hear. So which is like actually giving some kind of a leeway for Bharti to get, because they've already raised fund money. But that doesn't mean that the investors are easily, they will believe that this money will be forked out towards Dish TV to get that kind of a cable muscle to fight against Mukesh Ambani. So market is very well aware about this kind of developments, and we'll see. We'll have to wait and watch how Bharti Airtel will be taking this deal further in coming days once they get a clarity on Supreme Court issues over AGR and other dues.
All right, Sanjay, thank you so much for getting us those updates on Dish TV. Well, we'll continue to keep track of the further developments when it comes to this particular story. And for now, of course, as you can see on your screen, we're looking at a gain of around 5%. But, well, shifting focus back to the markets right now, the Nifty is currently back down by as much as 0.4%. It's the same for the Sensex, and the Bank Nifty also down around 0.5%, which would make it an opportune time for us to get in our technical experts. We have Amar Singh of Angel Broking, who's joining us on the show. And we also have Sacchitanand Uttekar of Tradebulls Securities. Good afternoon to both of you. Thanks for taking the time out. Amar, I start with you. Where do we go from here? What's the view when it comes to the benchmarks?
Yeah, I would say that what I've been saying earlier also, that we are seeing some sort of profit booking at higher levels, and also ahead of the budget we could definitely see that. And also, as I've been talking about earlier, that we are seeing bearish divergence on Bank Nifty. And if you look at Bank Nifty, that continues to be, I would say, weak on the daily charts, or the long-term trend still remains positive. But now it's moved in oversold territory, so there is a possibility of a temporary bounce back. So somewhere it has got strong support coming around 30,800, 850 levels. But one needs to be cautious on the long side, because till the time we don't see Bank Nifty consistently sustaining above 31,700, 31,500, 700 zone, I would say that it could be in a range play. As far as Nifty is concerned, Nifty again, we are seeing some. For the last, if you see, except yesterday, almost 5-6 trading sessions, Nifty was completely in a consolidation zone. And we saw a sell-off yesterday, and today also we are seeing some weakness. So as far as Nifty futures is concerned, support is seen at around 12,100, 12,150 levels, whereas the resistance is seen around 12,250, 300 levels. And the short-term trend is now indicating that higher levels, sustaining higher levels, is something going to be extremely crucial for the uptrend to remain intact. However, the long-term, intermediate-term trend still remains positive.
Okay, Sacchitanand, good afternoon to you as well. What is your view on the benchmarks, and what is the way forward?
Well, good afternoon. If you look at the overall structure, we have been maintaining a bullish bias on the markets, and we were expecting a swing somewhere close to 12,460 according to the broadening formation which has been established on the daily scale. So if you look at yesterday's event, we saw a sharp sell-off from close to that particular level, and we have a bearish bell-curve formation. So for the week, it is very clear that until unless we don't swing about 12,460, markets may not have a confident run on the upside. On the lower side, the supports are very well placed, somewhere close to 12,100. And if you look at, the other variables, if you look at the VIX, which is now quoting again close to the 16 mark. Now, the last time when we saw VIX around 16 mark, the Nifty was somewhere close to 11,900, and, we were sliding lower. If you look at the put-call ratio, it is again standing at 1 and 0.08. So it is again, coming into an oversold kind of a zone. So if you look at today's price action, it is very clear that we are, the market is testing its support. So probably as of now, the view would be neutral for the day. But in case if we see Nifty, sliding below 12,150, then probably some shorts can be deployed. The stop loss for the trade should be placed at around 12,850 on the closing, 885 on a closing basis, and an expectation of a move towards 11,900 will be open. So as of now, we are just maintaining a neutral bias, but yes, the overall structure has changed, and probably markets are now in a bear grip. So any particular rise in the near future should be utilized to exit longs, and probably from a trading perspective for a very short-term time frame, 12,150 would be very critical. In case if we breach that, then the trajectory on the lower side opens up to 11,900.
Okay. Let's talk about individual stocks as well. Come to you, Sacchitanand. Stay with you rather. Let's see what kind of stocks can one trade on this afternoon.
Well, purely from the budget perspective, BPCL is something which is again interesting. If you look at the overall swings that have been formed in last 15 trading sessions, we saw a formidable base somewhere close to around 460 zone, and a couple of weeks back we saw a bullish spike getting occurred near to this particular level. So it looks like the stock is making a double bottom kind of a scenario. So the intention is to buy the stock for an immediate target of around 485. On the future, the stop loss should be placed at 457. And on the sell side, Asian Paints now looks weaker. So if you look at the overall structure, again, a very similar formation which we saw on the indices. It's a broadening formation with the higher end somewhere close to around 1810. So we have already seen that particular swing getting breached. So the stop loss for the trade should be placed at 1828 and fresh short should be considered. We are expecting an initial swing towards say 1755 in a day or so.
Of course, Asian Paints will also announce earnings tomorrow, so that will be one of the other big, of course, talking points tomorrow. But Amar, what about you? What stocks are you keeping in mind today?
Yeah, I would say one stock to look at is Bharti Airtel. This is one stock I would say definitely very strong and positive on the charts. And technically, if you look at it, it's very close to major levels it has breached. So if you look at the quarterly levels, it was having very strong resistance around 500 marks. So that has been taken out. And the stock then has a potential to rally towards 540 odd levels. And technically, if you look at various time frames, what we are seeing is that the bullish momentum is definitely there, and the bullish momentum is showing signs of further gaining in strength day by day. So this is one stock one can look at, currently around 512, 513 levels. Any pullback towards 505, 506 levels can be used as a buying opportunity with a target of 534 on the upside and stop loss of 487. And the second stock to look at is Zee. Zee is one stock, if you look at it, this is one stock which has bounced back today. And it has been forming a bottom, because if you look at the stock for almost many trading sessions, and also there's more of a double bottom formation in this particular stock, and it has moved from oversold territory. And even the longer term time frames, we are seeing it moving from oversold territory. So this is one stock one can definitely look at from the long side. So any pullback towards 275, 277 levels ideally can be used as a buying opportunity with a stop loss of 263 and a target of 293 on the upside.
Okay, those are some stock ideas that you need to keep a track of. Your worst performer on the index is LIOC, which is at 115. Asian Paints also has lost about 2.5% in today's session, so 1807 right now for Asian Paints. Amar Singh, would you be a buyer in Asian Paints if it breaks 1800 on the downside?
Yeah, looking at Asian Paints, what I would say is that though the overall long-term trend remains positive, but the intermediate term trend, we are seeing bearish divergence on the charts. And also if you look at the stock I would say in November, it had made a high of 1834 and recent high was 1862. So somewhere there's a double top formation also on this particular stock. So I wouldn't recommend buying at the current levels, but yes, the stock does have very strong support coming at around 1780 odd levels. From there we could witness a pullback, but again, till the time we don't see it sustaining above 1840, 1850 levels, it could be range bound. So only on dips one can look at buying, but one needs to remember that upside seems to be capped for this stock, at least for the near future.
Okay, guys, hold that thought. Let's address Canfin Homes, the stock in focus, which is the stock in focus today, and the stock has seen its biggest one-day jump since April of 2015 after strong earnings and a bullish management commentary. We have Shefali Malik, who is taking us through what the management has suggested on the outlook going forward. Shefali, good afternoon.
Good afternoon, Agam. First of all, the earnings were stellar for Canfin Homes this time around, with net interest income growth of 24%, profit growing by 44%, and the loan book grew for them by about 15%. Fresh disbursements saw a growth of 12%, and margins were very good for them this time at 3.42%, seeing a growth of almost 10 basis points on a YY basis and almost 8 basis points on a sequential basis. Their cost to income ratio is also quite attractive at 15.55%, and asset quality was also steady for them, with both gross and net NPAs absolutely flattish on a sequential basis. So a couple of points which the management said in the con call in the morning, which the street has really liked, and hence the stock has run up. So one of the things that they said is that in next 4 to 5 quarters, disbursements growth will be 20%. That is, we can see that kind of growth not just over next few quarters, in fact, but over next few years as well. So that is something that has gone down too well with the street, especially considering the fact that we have been seeing sluggish credit growth across the financial services industry, and margins are expected to remain stable at current levels at about 3.2 to 3.3%, and asset quality as well, they expect that to improve in next couple of quarters. They don't see any impact of the stake sale process being called off by Canara Bank, and also the management expects to raise money in next 3 to 6 months. About the RERA issue, the company said that the RERA issue in Karnataka, that is resolved and the growth is back. Remember, in Karnataka they do have exposure of about 9 to 10%. That is their disbursements figure this time, so that is quite sizable. And more importantly, the management said that it expects a credit rating upgrade in the next few months, so that may lower their cost of funds even further going ahead, and the margins may look brighter even more because of that. So overall, very positive commentary coming in from Canfin Homes, and we can see the rub-off effect on some of the small and mid-sized housing finance companies as well in today's trade, such as Repco, GIC Housing, LIC, PNB Housing Finance. All these companies have been in green since the morning.
Right, Shefali, thanks very much for that. Indeed, a buzzing stock in the afternoon trade. It's up in double digits on the back of good numbers and the kind of guidance that the management has put forth. Now, the stock has moved up further. It's up about 19%, 71 odd points gained in today's trade. 461 is where the stock's trading at. Rightly put, even the others in the same sector are buzzing. Dharmesh Kant of IndiaNivesh Securities is joining us right on the show. Dharmesh, what's your take on some of these housing finance companies? Disbursements and the projection of disbursements rather more encouraging. Canfin Homes talking about a 20% disbursal rate. That obviously, in a way, also talks a little bit more about the health of the industry and how it's shaping up.
Yeah. See, whatever checks we have done on the ground level, what we have noticed is tier 3 and 4 kind of cities, there has been a traction in housing, especially affordable housing segment. So low ticket size kind of a housing has been doing well, and Canfin Homes, LIC Housing Finance, PNB Housing Finance particularly caters to this kind of a segment. I mean, from ticket size of 5 lakh or 2 lakh to 15 to 20 lakh kind of flats which they cater to. So that segment has done well. And again, there's a disconnect if you go by the numbers which banks have reported on the retail side. So there was a deceleration in the growth. I mean, retail consumption has been slowing down, but housing finance, as far as affordable housing segment is concerned, there has been a traction, and Canfin Homes number are evidence of the fact. So these valuations were pretty cheap, and going forward, as credit cost is likely to rise because the delinquencies are lower, and the guidance given by the management was quite robust. So I think that has taken place. The stock price has been moving on that count, and in this market, you have very few pockets where you can comfortably place your bets. So valuations are comfortable, and the picture looks rosier on the going forward for at least 1 year. So I think the traction we are getting today is more on account of that. Having said that, my top pick in the segment still remains LIC Housing Finance. So we have recommended this stock quite low at 390, 380 kind of levels when it was trading a couple of months back. And I think in the present scenario, that's the more stable bet to play on the housing finance segment. Overall, the sector does look attractive to us.
Dharmesh, we've had a whole host of private banks coming out with earnings, the leaders. By that I mean HDFC Bank, Kotak Mahindra Bank, IndusInd Bank. What have you made of the earnings so far? We've clearly seen a lot of weakness after they reported the earnings. And how would you assess the outlook for some of these banks going forward?
Yeah, I mean, to put it harshly, the outlook looks quite scary because on all the accounts, the earnings which they have reported, be it IndusInd Bank, HDFC Bank, Kotak Bank, that doesn't look a very rosier picture. In fact, the segment, the retail segment, which was doing particularly well for the last 2 years, and that was the driving force behind all the banks. That is getting decelerations is seen out there, and that's a big cause of a worry because the entire thesis of this economic upturn or green shoots or revival, which was on the basis of retail will pick up in a greater way, and that will lead to private consumption, which looks as of now the question mark is there. And the deficit of Government of India as far as revenue is concerned, it's getting low. The tax projections which are there, although it's not confirmed yet, but it will be low, and given the corporate tax rate cut which the government is given, it has to be that way. The earnings which most of the companies have reported, if you look at the bottom line, it is primarily because of the taxation advantage which they have taken. So I do think that something magical needs to be done by the government in the budget to pep up the economy. Otherwise, hard times ahead. So we may get trading blips, of a couple of percentage point on individual stocks. But my own sense is that given how the valuations have been, how the corporate loan growth has been, and how the retail is now decelerating, there will be a tough time ahead for banking space to carry on from here, and that needs to be addressed. And I'm not very clear how this issue will be resolved in a near term. Maybe a year from now there are chances, but as of now, it's more of a exit kind of a space for private banking from our decks.
All right. I should look at Info Edge as well. And the stock is trading higher after Zomato signed a definitive agreement to acquire Uber Eats. That's Uber's food delivery business in India in an all-stock transaction. The stock's up closer to 1%. Was up about 3.5% in early morning trade. Just trying to get the management to talk a little bit more about the contours of this deal and what this does to Info Edge's stake in Zomato. But that's in a few moments from now. What's your take on Info Edge, Dharmesh?
See, given the valuation at which it is trading, I think it's fairly valued. But the management has been pretty aggressive in taking the other areas of business forward, like this present acquisition of Uber Eats by Zomato, which is indirectly, a minority controlled by Info Edge, is again a step in the right direction. So I do think if the corrections are there, the company has seen a turnaround in the numbers. This year has been good for the company, so one should be a buyer and investor in Info Edge. Trading perspective, I don't know how long it will hold, but given the scope of opportunity which is there, and in this delivery model system, it will be more of a duopoly as of now. So it's a positive for Info Edge.
All right, so as far as Info Edge is concerned, this is just a part of one of the many acquisitions they have done. If any would consider this as a private equity proxy, because what the company does is that while it does have Naukri.com and something like a Jeevan Sathi, or for that matter, something like 99 Acres, Info Edge has the advantage of being invested in several of the other non-listed entities, which gives it an edge. which is why at least some analysts on the street would suggest that the valuations at which InfoEdge is currently trading at is, well, valid. That said, we also have to consider that a lot of these companies are not necessarily profit-making, and neither is Zomato. And when Zomato goes ahead and, well, acquires something like Uber Eats, it's not only going to require more capital, but there is a chance, and a very big chance, that it could also put pressure in the near term when it comes to InfoEdge's consolidated, income statement. That said, we all know about the tremendous presence that Zomato has and the kind of value that it can eventually bring to InfoEdge, and that is exactly what a lot of these investors are factoring in right now, as far as InfoEdge is concerned. Currently trading, yeah.
So, just to get a sense, this is obviously with Zomato and Uber Eats. Now, Uber Eats is about 12% of the food delivery market. So, this obviously is the added niche that it can get with the acquisition of the business in India.
Yeah, and especially if it is going to be competing with something like Swiggy. We always knew that Uber Eats was up for sale, and we always knew that, well, if it wasn't going to be Zomato, it was going to be Swiggy. It's just Zomato's advantage right now. It's something to do with, why Facebook would acquire WhatsApp. They may or may not see value right now, but eventually those advantages will start coming through, and that's exactly what Zomato is playing out here. It may be a very small acquisition, but 12% market share today, and eventually it could grow to a lot more. And of course, operations are in place. The only concerns the investors may have is the kind of cash burn that Zomato is already seeing, and it may require to shell out more.
So is it probably a better thing than that it's an all-stock transaction instead of any cash involvement? $300 to $350 million is what they're saying is the deal value.
Yeah. That's how much it's valued at. Well, it's going to be a wait and watch, and I'm sure that for Sanjeev Bikhchandani, he is one person, at least as far as the street is concerned, he would get the best value out of the deal. Of course, he does not directly own Zomato, and in this case, Zomato is owned by, well, many other investors. But I reckon that at this point in time, at least the street is giving it a little bit of a thumbs up. But again, it's an indirect play when it comes to the play out in terms of the income statement, and it's going to have a long gestation period. We all know about that when it comes to InfoEdge. But let's do a chart check too. Sacchitanand, if I can come to you on InfoEdge, how are you looking at? Well, it has been trading within a narrow band over the past few weeks. What's your view here?
Well, first of all, it's in a very strong secular uptrend. In fact, if you look at the entire, weekly chart, we have seen a series of higher tops and higher bottoms getting continued. In the last 15 weeks, we have seen it consolidating, but, it seems that the base is now shifted towards 2300, and probably in case someone really wants to invest in further, they can still do it. 2300 is would be a probable stop loss from a trending perspective. Though we're really not seeing any firm breakout getting established right away. But I think the stock may consolidate a bit more, and probably eventually we may see levels close to around 3200 going forward. So definitely an investment stock, but not a trading one. 2300 should be the stop loss for the trade, and any consolidation within 2650 to 2400 should be utilized to trade longs.
Right. Dharmesh, just coming to you on the auto space right now. I mean, we just heard from the president of the FADA with regards to new registrations coming off. January may be a month where you do see a slight bit of a pickup, but again, there are no, really material green shoots in sight to suggest that things are really picking up on ground. Do you feel that this lag in the auto space is likely to continue for some time into FY20 before we actually start seeing any reversal?
I mean, couple of months we are away from the auto space actually bottoming out as far as two-wheeler, three-wheeler or passenger vehicle segment is concerned. But this is a time to get invested into the auto space because stock prices are ahead of when the numbers actually turn around. So as of now, what we think is January may still be sluggish. The numbers won't be good. That is what the dealer checks are suggesting as of now. But February onwards, you will see traction picking back into the entire auto space. And so what we are advising our clients is to get invested in a staggered approach. And the space which we are liking is basically two-wheelers, that is Hero MotoCorp and Bajaj Auto remains our topic out there. And Bajaj Auto's, Chetak launch, the electric vehicle will have a tremendous response. That is what the ground level checks are suggesting. So that again makes a good buy. On the MSCV space, we think that scrappage policy is round the corner. So once that is rolled out, it will be definitely in a piecemeal approach as far as Pan India is concerned. But again, that will give a flip to this space which has been languishing for quite some time. So MSCV, LCV and SCV segment will pick up after this rollout, and the infra push by the government again needs transportation of materials to build infrastructure. So that will again push the sales up. So Ashok Leyland is our topic out there. Scots we have recommended way back, and it has run up quite high. So as of now, one can take profits or be out of that. So overall, we are constructive on the auto space, but auto ancillary one should wait and watch as of now. So stay away from auto ancillary, but Hero, Bajaj, and Ashok does merit a buy here.
All right, Dharmesh, we'll leave it at that. Thank you very much for joining us this afternoon. All right, back to InfoEdge. Then Uber Eats has just sold its India business to Zomato. The deal in the food delivery app space has been struck at $270 million. Joining us right now to talk about the deal is the Chief Financial Officer at InfoEdge, Mr. Chintan Thakkar. He's joining in right now. Mr. Thakkar, thanks very much for taking up the time. Run us through the contours of this particular deal, and what is the final holding that InfoEdge will have post the completion of this deal?
So, post-conclusion of this deal, InfoEdge will hold about close to 23%, I think 22.71 to be precise. And we would be second largest shareholders once the deal is done.
What's the plan in terms of getting an increase in market share within this space? I mean, at the time of acquiring Uber Eats, what has been the game plan to make sure that you reach a certain level of penetration within the Mumbai market, within the India market, and the growth there?
Yeah. So it's all about garnering more and more critical mass so that the unit economics, also improves from where we are. As you know that, the overall cash burns have started coming down for Zomato and in a very significant way. And we think that, this gain in volume and increased share in some of the cities and some of the territories will improve our position from the growth standpoint as well as from the cash burn standpoint. So overall, we think that from both perspective, this should be a complete win-win deal for us.
Chintan, but that's exactly what I wanted to ask you about the fact that, while the cash burn may have come off for Zomato, is there a possibility that it may inch back up, considering now that, Uber Eats business is also going to be a part of Zomato? Would that have at least near-term pressure going forward?
Well, I think the consolidation should improve that cost structure. So we don't think that it will worsen from where it is. The volume growth would be there, and volume growth will get more critical mass, and that should have a positive impact on the overall unit economics.
Then where would the consolidated entity, that is Zomato and Uber Eats, land in terms of the competitive scenario? If you could share with us any numbers with respect to market share or any other variable.
Yes, basically, from the legality standpoint, the consolidation is that, as a standalone company, Zomato has bought the assets of Uber Eats, right? So everything will start, getting reported into the standalone entity. It's hard to predict the number in terms of how the growth rate would be, but we would think that we definitely would be number one in terms of competitive landscape once this deal is done and the traffic moves onto Zomato side. We definitely think that it gives us the edge in terms of leadership in this space.
So, on a consolidated basis, Chintan, when it comes to InfoEdge, what sort of impact will Zomato eventually have on the bottom line? That's one. Will it affect the FY20 numbers as well? And of course, going forward, what is the outlook when it comes to the bottom line with respect to Zomato? Then perhaps some sort of an impact in terms of outlook for FY21 too.
Yeah. So FY20 just only now, 3 months are left, So most of the FY20 is over. So it may not have much impact on FY20 numbers from this deal standpoint, However, having said that, the fact that Zomato has been reducing its cash, burn, obviously that would augur well for our consolidated financial statements as well. Zomato is not our subsidiary; we are not operating. However, it's our affiliate, and we do kind of consolidate its net profit and net losses into our consolidated statements. So that should be improved because the cash burns have started coming down as compared to what it used to be earlier. So I think it's improving position, and we think that FY21 going forward, that those efforts will continue, and as I said that but its growth coming in should help not only the top line, but it should also help in reducing the cash burn. So overall, we think that it should have a positive impact on our consolidated financial statements.
Last question, Chintan. Now, obviously, while India constituted 3% of the global gross booking for Uber Eats, it also constituted about 25% of the EBITDA loss on that scale for Uber Eats. Do you feel then that initially there could be some pressure?
Well, I don't know, these numbers, what their global numbers are, Uber Eats. But what we think is that since we have bought some of the assets, we are not really buying the operating losses that, I don't know their cost structure and how they were burning cashes. But some of this, I would assume that some of these losses would be because of the discounting that's being offered, So now that it will come under Zomato, probably it would be on the lines of what Zomato would strategize, right? So it need not necessarily be on the lines of what the Uber management was doing it, So basically it's an asset purchase, and the more volume will grow. So we don't think that unless and until we follow their strategy, that we would inherit those losses.
Got that. Chintan, thank you very much for joining us and highlighting the contours of that deal. Time now to head across to Davos, where Menka Doshi is standing by with Fang Gang, Director of National Economic Research Institute at China Reform Foundation.
You're watching BloombergQuint here in Davos, and I have with me one of the most important voices here, Professor Fan. Professor Fan is of the National Economic Research Institute of the China Reform Foundation. He is one of the most renowned economists in China and a strong advocate for reform. He's consulted with many government departments in China and has also been a member of the PBOC's MPC, that's the Monetary Policy Committee, as well as a consultant to many international institutions such as the World Bank. Professor Fan, thank you very much for joining us here. Davos begins on the back of the announcement of the Phase 1 trade deal between US and China. Do you believe that this is a sustainable toll in, the freeze that we've seen over the last couple of years, or do you believe that it's only just temporary?
Well, have an agreement is better than none, right? But I don't think this is solved all the problems between two countries. On one side, the trade deficit of US is hard to be, eliminated by selling China the primary goods, the bean, the pork, the gas, from a technology most advanced country. You are not selling us your advantageous goods, but all those primary goods. I don't think that will be sustainable. That's one thing.
Okay.
Secondly, the decoupling effort by some Americans are not stopping. So it's still going on, and a lot of things are not in this agreement. Right. So I would say this is a good thing, but not yet solve all the problems. So we need to make more effort to improve the situation and the relationship between the two countries.
Do you believe that effort is possible in a year where we are going to see presidential elections in the US, and this has been a political point to score?
Yeah. Well, this is kind of the uncertainty which this disagreement didn't remove, because if things are determined by the domestic politics, it could be very damaging for the international relations. So we don't know when it's necessary for the domestic politics. Somebody will oppose more sanction or more, the tariff, and when the negotiations for the phase 2 will start, it's all uncertain. So that's not really good thing for both countries, I would say.
The other point of news that we just got a couple of weeks ago is that China's GDP grew at 6.1%, the lowest since 1990, but not a bad number given that last year was a difficult year. What do you make of this kind of GDP growth, the internals contributing to this growth, and what that means for not just this year, but this entire decade for Chinese growth?
Right. Well, the Chinese economy is a large economy. That means the outside factor may have an impact, but mainly from domestic reasons. So the trade war make the negative impact, but main reason for this downturn is because of the domestic, overcapacity issue have not yet totally removed, and the market clearing is not finished. But things are getting better. It's stabilizing, and the market clearing is going on, and it's going to be finished. I mean, in the last phase of the transition. So we would expect the economy in 2020 will be stabilized. One thing, if there's no higher growth, but at least it will stabilize at around the 6%. And then next stage will be determined by how much reform and how much structural changes would really take place in the economy.
When you speak of reform and structural change, one of the big shifts that has been underway in China is the move away from an investment-led economy to a consumption-led economy. How do you assess the success of that shift by the Chinese authorities? And do you believe that what will be the next stage of reform as you speak that will dominate this decade?
Yeah, the consumption now really is growing as a part of the GDP and as a contributor to the GDP growth. The reasons are really solid for this kind of change. Number one, by the end of the 2019, China's per capita GDP reached the $10,000 US dollars. Yes. So this is a trademark. This is a milestone, milestones, and that indicate that the people really have the money now for the consumption. Number one. Number two, Social Securities have been really reformed and really now start to function for Chinese consumers. Not only the urban people. The rural people now got some basic securities, so that will make big contribution for the lower saving but a higher consumption. And also, this digital things really improve. Before we didn't have this so-called consumer credit. Now, by the internet, it's really growing very fast. And the commercial, e-commerce, that's really fascinating. And also very important thing is that before China's saving rate is high because this saving is so low. This saving means old people. They didn't save much money before, and after retirement they are not going to spend much money. But after the 40 years, the people have the savings, people have the money, now retire. So the structure of the economy, the population, really changing. So that will also make the consumption continue to grow in the next decade.
So I believe that the investment contributes about 31% to GDP. Consumption is now at 51%. What do you believe would be the ideal balance that the Chinese authorities will be able to strike in the course of this decade? How much more down the road does China need to go?
Right. Well, at this stage of development, actually, as an economist, I do not want to see the investment going too low, because the saving rate is still 43, 42%. Right. So to utilize those, savings, you need some investment, and also China's investment in the social capital, in terms of the infrastructures, urbanizations, you still need the investment. And China now is going to second phase of the urbanization. In the early phase, you have the small cities grow up, but also big cities. But now the government finally adopted the policy encouraging so-called big metropolitan area development. You may heard, the Hong Kong, the Shenzhen area, and also Shanghai. That's a big area for the urbanization. It's a group of cities too. So that also needs some investment. That will lay a better foundation for the future growth of consumption. So I would say at the moment, this structure, this is the percentage, the ratio between this consumption and the investment is okay. I would like to see that will stay for a while, say 3 years, 5 years, then go down further. We calculated many years ago, say if China have basic equity of the income, the better the ratio is something like 25 to 65.
25 to 65.
Yeah.
So you're not very far away from that at this point in time.
Not very far away.
Okay. You mentioned, Professor Fan, that the overcapacity issue in China has yet to fully play out.
Yeah.
How much longer do you think that will take? And I'm going to juxtapose that question with the second point that, whilst we did think that these trade tensions will hurt China in some way, from what I understand, exports have gone down only marginally. China has been able to redirect exports to other nations, and whilst these trade tensions need to be resolved, they're more a political resolution than just an economic resolution. So where are we in the sort of the cleaning out of the overcapacity issue? And do you see export playing a bigger role in that cleaning out, or will it have to be any other resolution?
Okay, the overcapacity mainly is related to the investment. If too much investment and it created too much demand for those investment goods, not really export.
Yes.
Export continue to be at a high level, but in recent years, because of trade friction with some countries, now is growing marginally. However, China's export to other countries, emerging market, including India, Russia, and also ASEAN, Africa, other markets is really growing. Last year our export to U.S. was down by some 14%. But overall, export continued to grow by 2.3 percentage. That means our export to other countries still growing.
Yes.
So I'm not saying the export will play the role like in the 10 years ago, 20 years ago, contribute too much to the growth. But I would not saying it will be decline or it will disappear. China's capacity of this export is to continue to be strong, and if we can do more to the to the opening up further, to remove some restrictions for foreign capitals, then the growth of the export, including the export from the multinationals in China, will continue to be the part of the growth story.
All right, that is live coverage coming to you from Davos. Do stay tuned to BloombergQuint Live as we get you more coverage from there. Back to the markets then. Rahul Arora of Nirmal Bank Securities is joining us on the show this afternoon. Rahul, good afternoon to you. A little bit of uncertainty now the last few days has been as we've stepped into the earnings season. They've not met expectations. In fact, they've dampened the earnings season mood so far, at least from the private sector banks. But what's your take on how this is likely to shape?
So thanks for having me. We were actually expecting the Nifty to be close to 13,000 entering the budget. We had a published note in the first week of January, or maybe towards the end of December to that effect.
13,000 is a year-end target for many.
We were actually expecting it by the first. So if you look at the 52-week high of the Nifty, it's around 12,450. And if you actually adjust the 250 points for the Iran crisis, we were practically at 12,700, because when we wrote that, there was no clarity that something like that would hit us out of the blue. So you were almost sort of kissing that level of 13,000, which we were sort of expecting. And I think more than everything was sort of priced in, is what we had felt. So even if the Nifty was to go back to 12.5, 12.6 right now before the budget, I actually think it is a very good chance that even if the budget is a blockbuster budget, which people are expecting it to be in the context of everything that's happening around us socially as well as politically, I think that we could probably make a top for the year in the month of February. So whatever that level may be, we may actually, for academic purposes, hit 13,000, probably cross a little over, but I think that would probably be a good time to probably move into cash or safer investment assets as opposed to equities for the rest of the year.
Sure. All right, Rahul, so we keep hearing that the mid-caps haven't caught up with the large caps, but if you look at quality mid-caps, valuations are still where they were about a year ago, 2 years ago, very richly priced. So what does it mean by when people say that mid caps haven't caught up with large caps? Are there still pocket of value up there?
So I think there are two ways to look at this. One is, of course, people are very eagerly awaiting the next change of the mid cap definition that's going to be announced, hopefully in the not too distant future. And I think once that happens, I think the flows will adjust themselves accordingly. So that is one technical factor, so to speak, that comes in. The other important part to note is that the amount of passive investing as a concept which has emerged tremendously in India over the last 6 to 8 months is actually making fund management to that extent much easier and making our job a bit more redundant.
Sure.
Because you're constantly, as you said, buying those same stocks and taking them to much higher levels. And I can give you two examples of two stocks at our broking house that we have no idea what to do with at this price. One is Bata, the other is Whirlpool. They both doubled in the last 1 year. They're both sitting at over 40 times 1 year forward earnings, which they've never done in their trading history.
Right.
So we're a bit confused at our broking house as to what sort of exit multiple if an investor was to buy in right now to give them. So my sense is still you keep having these kind of monies coming in, even though the mutual fund numbers at an aggregate level were pretty poor for last month. The SIP numbers are still coming in at about 7,000-8,000 crores. So you are seeing a little pocket of redemption that's actually coming through on the mutual fund side. But if that's going to get compensated by ETF money or the SIP flows, till this SEBI definition doesn't change, I think the valuation reset on the way higher could potentially continue to happen in the non-index names that we've been seeing. I mean, it's something that we've been expecting to correct for a while, but it hasn't happened. And I think the reasons are more technical than fundamental. And when I say technical, I don't mean chartically technical. I just think the way of investing technical.
Yeah.
Okay. Let's talk about, the last few days. It's been sort of split down the middle. So while the index, the realty pocket as a whole has been doing well, stocks have been at poles apart. So where you have a prestige estate, Soba doing well. Yeah, on the flip side, Godrej Properties is suffering a bit more. Oberoi is not picking up to pace. Do you see this fragmented move in the industry? Do you read much into it?
So Devina, I think the way to look at it is to differentiate residential from everything else. So obviously there's commercial, there's retail, but I think the stock price performance indicates that there is a huge expectation going into the budget for something to come out for the residential sector. Because till that part of the economy doesn't revive, India is probably not going to go back to a 5.5–6% GDP growth, let alone 7%, which is a call that our economist has put out for FY23, by the way. But I think, if you look up the JLL, Knight Frank, Anarok reports that they've been putting out over the last 6 to 8 months, I think one thing is clear that commercial and retail is actually doing pretty well. Residential, even though the launches have been lesser and lesser, and the sales have picked up, I think the gap will probably take another 12 months to correct itself. In that backdrop, I think the names you pointed out, barring Shobha, which is again purely a residential play, I think if you must be in real estate, you could probably look at names like a Phoenix Mills or a Brigade. Prestige has a reasonable commercial portfolio. So I think you'd probably be better off playing the names that have a fairly reasonable amount of land, sort of parcel of land that they've developed or are developing in the commercial and retail space, because I think the rentals there are picking up. You're getting very good lease and fit outs. You know, BlackRock globally has done some very good deals. Embassy REITs after its listing has done really well. So I think there is a story there that residential will probably take another 12 to 24 months to pick up. Even if things go right in the budget, this is not something that kickstarts right away. But you probably need to. Nesco is another one that's probably an hour down the road from us in terms of their main asset. That's another one that's doing pretty well for itself. So I think commercial and retail will probably continue to do well as opposed to the residential side.
Okay, well, hold that thought, Rahul. Let's also take a look at what dealing rooms are recommending to their clients. We have Darshan Mehta, who's joining us to give us an update on the same. Darshan, what do you have?
Yeah, so one of the stocks, Agam, that's been spoken about is AI engineering. Look at the volumes today. If I looked at the volumes, and the volumes are highest it has since September 2019. Usually 10 to 15,000 shares get traded, so there is enough volumes that are happening on the counter. Basically, just to give you a brief, these guys make grinding balls that are used for cement as well as metal industries. Ferrochrome prices are down 30% in the near term, and ferrochrome is a key raw material that is used for AI engineering in making their products. Net cash company, hardly any debt on the balance sheet, and it is being played because of growth that is there on the cement expansion and the trade war. If that actually happens, there could be a spurt on metals. So that's one of the key reasons why some of the funds have indicated they are accumulating AI engineering. Retail as a space has done well today. Look at Shoppers Stop, look at V2 Retail, there is V-Mart. All these counters have done well. Some of the domestic funds have started actively accumulating some of the retail stocks in trade today. RBL Bank, that is one key number that everyone will watch out for in trade tomorrow. It's ahead, it's up almost 4% ahead of the numbers. The belief that the street has is this time around, probably it will report a strong set of numbers.
All right, Darshan, thanks for getting us that update on the dealing rooms. But, well, it's 3:20, so let's very quickly also get in closing strategies from our experts. Amar, I come to you. Your closing thoughts for now.
Yeah, I would say that I spoke earlier also. Zee Entertainment is one stock one can definitely look at, because this is breaking out of a consolidation, and also on the it's positive on the short term as well as the intermediate term, and on the long term we are seeing that it is moving from oversold territory. So this is one stock one can look at. The potential target levels are around between 295 300 levels in the short term.
All right, Sacchitanand, the same question to you.
Well, I'm looking at creating more shorts, and now it looks like auto is the weakest of them all. So, you know, a short call on Maruti, the stop loss for the trade should be placed at 73.65. We're expecting this swing to, you know, extend towards 7,200 in a day or so. So fresh short positions can be taken in Maruti.
Okay. Rahul, anything that you're in particularly optimistic about post-budget, or anything that you're eagerly awaiting to come out from the budget? From a market standpoint, we've been hearing a whole lot of chatter about whether or not the LTCG will be a point of contention and whether something will be done on that regard. And also bringing foreign funds or allowing foreign funds to conduct operations in India is something that we've heard many more market experts talk about.
So I think, Devina, it will all get captured in at 13,000. I think all of that you're saying will probably get captured in there. I really don't see how much more you can potentially discount. Your opening line was telling enough that earnings have not, worked in favor of the market. And, you can just go back. I mean, I've spent 9 years at my broking firm, and barring the last 1 year, if you take an 8-year average, earnings growth, GDP growth, and markets align themselves. There will be a period that the markets will probably just go to sleep with all the good news that you possibly get as well. But I think the big theme perhaps to play in the next 1 year, given the fact that I think the government is going to be cognizant of what's happening in rural India. You've had a good monsoon last year. If the sowing for the winter crop is good, I think there could be a revival. I just heard one of your colleagues talk about some of the retail stocks. We do cover V-Mart retail. I think that could be an interesting play. Now, the funny part is when the market was defensive, you saw buying in FMCG names. If the focus shifts back to rural India, there is still a play for these FMCG names. So I still think that the likes of Britannia, Lever could make a play in the next 1 year. May not be the way that they have in the last couple of years. But I think another important theme from a consumer standpoint that would play out, especially in the backdrop of today's ICICI Prudential life insurance numbers, I think life insurance as a theme could continue to do pretty well over the next 1 year, especially if you have a little bit of tweaking with the with the taxation, personal income tax, and people get a little more money in their hands. I don't think all of that's going to get plowed into consumption. I think there are other assets, or there are other financial saving products also where you could see a little bit of this money come in. So life insurance could be an interesting play. I think the order there would probably be SBI Life at the top of the pack, followed by maybe an ICICI Pru Life, Max and HDFC Life probably in that order. Only because of valuations I'm putting HDFC Life at the bottom of the pack. But I think rural and insurance could be the theme for the next 1 year, keeping in mind what the government may do with respect to the rural side of the economy, and if any relaxation on personal income taxes, I do think some of that money will find its way into insurance.
Do you continue to stay positive on the QSR space, something like a Westlife, especially given that we will soon see the Burger King IPO come around?
Well, I'm actually quite excited because Burger King is essentially a loss-making entity.
Right.
So I think there'll probably be a reset given the subscription numbers for Westlife particularly.
Right.
I think people will have to align themselves to the fact that the GDP growth is nowhere close to what it was a couple of years back. So the SSG growth may not be as gung-ho, but I think as long as they're able to report positive SSG growth in and around inflation numbers, I think we should reasonably able to sleep peacefully. I think, given where interest rates are and given where inflation is, I think people need to reset their overall expectations from return on equity of a company as well. So I think gone are the days where you would probably pay a premium for 35-40% ROEs. I think in the current overall environment, if you're getting a company at 20-25 ROE as well, you could probably see a reset on valuations on the upside. And Westlife is one company that's probably on that trajectory.
Right.
Jubilant is already there. But I think there will obviously be a little bit of tapering of expectations, but nothing to scoff about. I think as much as I hate to use this word, the long-term story of these two stocks is firmly intact.
Sure.
And just a case in point, for the last 30 quarters, Domino's has reported positive same-store sales growth in the United States. If that's not a saturated market, we're nowhere close to it. So I think we'd keep the faith there.
All right.
All right, Rahul, we'll let you go on that note. Thank you so much for joining us.
Thank you for having me.
All right, just quick chart checks then before we start winding down to the session. It's down about 0.5% for the Nifty 50. I want a quick view, Amar Singh, from you on some of these cement names. Shree Cement for one, which was an outperformer just a few days back. The last 1 month, it's gained about 11%. Today is down, but not as much, still down about 1% or so. Would you take an entry point here?
Yeah, I would say that this stock definitely remains positive on the chart. So one can look at initiating long, but ideally if one looks at, then a good level to enter is somewhere around 22,400, 500 odd levels. So any dip towards those levels can be used as a good buying opportunity because the stop loss needs to be below 22,000 levels.
Okay, Avanti Feeds is the other one. I just want to pull that stock up. I think, after the initial pop and the excitement, the stock actually in today's intraday session itself went down to sub 680 odd levels, closer to those levels, and then from there has seen a very smart recovery. It's actually back into the green now, so 697 back at 700. Is there an open position is there a trade here, Sacchitanand?
Well, I think the stock has already seen a phenomenal run up, and in case if we see levels close to around 720 in a day or so, those levels should be utilized to book profits, and fresh entry would not be advisable from here on.
All right, stay on with us, gentlemen. We'll come back and get your closing thoughts as well. But just about 3 minutes left to go for market closing, and we're shutting shop for the day with cuts of about 0.5% on the Nifty. We are now down below that 20-day moving average. What becomes more important is the 50-day moving average, which falls at about 12,101. Bank Nifty has lost about 125 points, so 30,952. Breached that 31,000 mark in intraday trade. Coming to the broader market space, small caps are really, showing the outperformance, and this has been the case over the last 6 to 7 trading sessions now. Mid caps are also down marginally, just by about 25 odd points. Coming to individual stocks on the index and what has moved and what hasn't. Starting off with the gainers, Bharti Infratel for one is up 8.5%. I think it's the highest point of the day for Bharti Infratel. Zee ahead of numbers is up 4.5%. BPCL has moved up too. That's up about 1.5%. Some recovery for Kotak Mahindra Bank after that disappointing session yesterday. HDFC too recovers. Coal India is up about 0.5%. But the list of losers is longer, starting off with Tata Steel, which is down about 3.5%. M&M, IOC continues to lose. Yesterday was down 3%. Today is down 2.5%. Tata Motors, Maruti, the entire auto pack seems to be weak. And Asian Paints too seems to lose some steam right now. It's down closer to 2% plus. But Agam, the mid caps and small caps have outperformed, but I'm assuming it's very stock specific.
Well, it certainly is, Devina. There's no doubt about that. But there are quite a few gainers out there in the broader markets. I'm going to start off with those advanced in today's day of trade. Vodafone Idea, of course, well, it's not necessarily a mid cap stock, but certainly a non-index stock. And well, that's done well today. It's up 24%. We've seen Canfin Homes, and for very many reasons that we have discussed, it's locked in an upper circuit of 20%. So what an up move for Canfin Homes too. We have Hindustan Aeronautics, which continues to do well. In fact, trading near days highs, up around 7.6% as well. And the other one, of course, is AIA Engineering, which is also advancing by around 7%. These were a handful of gainers in today's day of trade, leading the broader market indices. Of course, on the losing end, you have pressure on something like a Prestige Estates, which is down around 8%. We have DCB Bank, which is also under pressure. A trader's favorite, actually, that's down around 7.5% too. And Power Finance Corporation, it's had a relatively volatile day of trade. It's eventually closed with losses of around 5.5%. But I reckon all eyes will be on the extended losses for the benchmarks today.
Yeah, and two more numbers actually that you're still awaiting from the broader market space. Havells, for one, is also going to be reporting its numbers today, and Polycab towards the end of the trading session. Posted in the evening, you will be closer to 6:30. You'll see the numbers of Polycab as well. Polycab has actually seen a big profit-taking session today. It's down about 4%. Havells ahead of numbers too is looking weak. Bank Nifty, and that's the final tally on your screen. 30,956 on the Nifty Bank. The Nifty 50 closes under by another 0.5%. Individual contributors up on your screen in terms of points for the index and what's gained and what's lost. So the biggest drag on the index today has been HDFC Bank, losing about 11 odd points. ITC, Infosys, ICICI Bank following suit. Gains coming in, marginal gains from Kotak Mahindra Bank, Reliance contributing just 2 odd points.
Fair enough. Let's also take a look at the advance decline ratio and see how things are panning out there on the National Stock Exchange. More declines than advances. It would be around 9 to 6 roughly. That's 9 gainers, or rather 9 declines for, well, 6 advances. And also to take a look at the turnover and see whether or not something really does stand out this Tuesday trading session. Well, I reckon not necessarily too much to go for out there.
Well, the F&O space has been extremely active. Yesterday was the first trading day of the week, and we saw a 12 lakh crore plus turnover out there. Yet again, the second straight day where you're seeing a turnover for about 13 lakh crore. So the F&O segment is extremely active. But let's get into those closing comments from our technical experts. Amar Singh, I'll come to you first. What will you watch out for tomorrow?
I would say that I would watch out for a crucial zone of support for Nifty at around 12,100, 150, because there could be further selling, but that's a crucial level of support. And again, on the upside, 12,200, 250 would be a zone of resistance. So there could be some selling pressure, but these are very crucial levels, because if Nifty sustains below 12,100 levels, then we could witness some sharp correction towards 11,900, 11,970 levels.
All right, Sacchitanand, what are you watching out for now? What's the way forward?
Well, very similar levels. In fact, we have the expiry, which is just around the corner, and as we discussed, 12,150 would be very critical. In case if we see slippages below that, then probably we may see a drag towards 12,000 very quickly, 12,000, 11,900 very quickly. But in case if we see a positive surprise tomorrow, and in case if Nifty manages to sustain above, say, 12,250 kind of a zone, then probably we may see a decisive pullback in the markets. But overall, the structure has shifted from a very stronger one to a very weaker one now. But the focus would be more stock specific in the next couple of trading sessions.
Okay, we'll leave it at that, gentlemen. Thank you very much for joining us this afternoon. Amar Singh as well as Sacchitanand Uttekar.
Thank you.
And with that, it's also a wrap here on Countdown from Agam, myself, and the entire team that's put the show together. Thank you so much for watching.